What a strange trip it's been, right? The last couple of days. Welcome to the live stream. Be the boss of your money. It's about personal finance, investing. Hopefully, well, not hopefully, it's about making the most of your money for down the road, for retirement, for now, balancing sacrifices for tomorrow with living well for today. And we could put it together in a plan and help you get the most out of your life pre and post retirement, right? That's what the show is really all about. And I'm so glad you're sticking with me and thanks for watching. The question is, just when things are so bad and the stock market has every reason in the world to go lower, and it's been going lower since July, August, and September. Lousy third quarter. Inflation continues to go up. Fed continues to want to push on interest rates a little bit more. And the phrase from the Fed, higher for longer, spooks everybody. And things are just negative. The market's going to slow. The economy is getting worse. Consumers are stretched. Just when you think it couldn't get worse, last Friday, on a much stronger than expected non-farm payroll employment report, when you think, oh, that's the last nail in the interest rate coffin, the Fed's going to keep raising, the market dips in pre-market trading, goes up during the regular session for a pretty decent day in the market. Over the weekend, massive terrorist attack, horrible, what's taking place in Israel. Hamas attacks Israeli citizens, Americans killed, some taken as hostage. We're talking about the market, not to get into the geopolitics and the horrible human suffering going on. But just when you think things could get worse, we follow through Monday with another update in the stock market. And then today, the market opens up. We finally see the impact on the bond market, interest rates, as expected. Interest rates went down a little bit because bonds went up because investors have this flight to safety, quick run into bonds where they feel safe. Not everybody, but just the marginal traders, they run into bonds. And we have a third day in a row where the market's up. Remember, yesterday the market was closed. The bond market, I should say, was closed. The stock market was open. But you think with all the bad news, and now you'd think that the war in Israel would be the icing on the cake for just a severe down market. And we go into rally mode. And I think this has a lot of people confused. And a lot of people have made some pretty bad moves, like getting all out of stocks, getting all to cash or bonds. And they're not taking a balanced approach. They're not taking the approach that works for them. They're not thinking with their head on straight, meaning geopolitical events, they come, they go, the economy goes on. We were in Afghanistan for 20 years. Has it really affected the stock market? No. Stock market's been up. We've had all kinds of strife. Remember 9/11? What happened? Market rebounded. Fed cut rates. Companies started buying back stock. We got through the tech wreck. And by March of 2003, stocks went into rally mode for 4 years until 2007. They hit the Great Recession. The housing market bubble blew up. Stocks went down from July peak to the March trough in 2009. And then they went up until about 2020. They went down on the pandemic. And then they rebounded until about 2022. Right? And now we're down again. And we'll rebound again. That's the way the stock market goes. This is what makes investing I feel like there's such a roll. My eye really bothers me today. Okay. And this is what makes the stock market. Let me start that again. And this is what makes the stock market so confusing to investors over the short term. When you expect it to finally collapse, it goes up. When you expect it to go up, it goes down. That is the nature of short-term trading, short-term expectations. But if you could wait, you should see the rebound. And when the market moves to new highs, it moves to new higher highs, higher lows, and the trend is an up and down pattern over the short term, but long term, it's going up. That's no different than any other time in the stock market. That's what we get. And this is why we focus so much on the minutia, on sharing the insights with you, explaining to you what's going on in the market. Let's roll the introduction. I know. 5 minutes into it, but I have to roll this. We're going to talk about what happened in the market. Exactly. I'm going to be very specific. So please stick around. Welcome back to the show, Be the Boss of Your Money. So what happened? Why did the stock market rally? Was it because we were oversold? Okay. Was it because we were oversold? Was it because corporate earnings have bottomed out? Is it because the Fed is expected to finally stop raising rates and start going into rate cutting mentality later in 2024? Is it because the employment figures came out really strong on Friday, more than twice as many jobs created as expected? And the months prior to that were revised higher, but wages were flat. So are we in Goldilocks, where meaning we have economic growth with low inflation, which is the best for everything, especially for financial assets? Oh, so many things to look at. Or was it just we're not going to really know what made the market move up at this point until some time passes by, which is the usual. We like to run and categorize things and give a reason for the short-term movement in the stock market. This is why it went up. The market just went up. This is why. This is what happened. But some time goes by until we really figure out exactly what happened. Maybe the market went up because people really believe that the Federal Reserve has the gumption to tamp down inflation, and investors finally take it seriously, which ultimately is actually bullish for everyone. I don't think that's bearish. I think it's bullish for everyone, in my opinion. When the Fed says we want to get inflation under control, they mean it. And investors now accept that. They take the Fed seriously, which is not something that they didn't really take seriously before. We're used to easy money, but now it's not easy money anymore. Companies have to adopt. No. Let me change that. People adopt. Well, we adapt. Companies adapt to changing situations. Faux pas. Okay. So market was up. Let's take a look at what happened. All right. Dow was up 134 points. NASDAQ up 78, up over 0.5%. S&P up over 0.5%. Gold up a little bit, continuing yesterday's rebound by another 0.5%. By the way, you cannot invest directly into an index, but you can invest into a security that tracks your mimics an index. Oil has been coming down. Very bullish for the stock market right now. And it was up yesterday. It was up about 4% yesterday. So being down about 0.5% today is not a huge deal. But investors don't seem to be overly worried that the war in Israel, war and terror in Israel, they don't seem to be overly concerned that this is going to spill over into the oil market at the moment. Interesting to note that Goldman Sachs yesterday says there is potential for much higher oil prices because of a spillover from the war between Israel and Hamas. Today, Goldman Sachs said we could see stocks go higher or stay where they are for the rest of the year, and we don't really see a big impact on the price of oil or the economy. You know, people talk out of both sides of their mouth. Companies do the same thing. And ultimately, this is why we keep saying you've got to live to your march. I should say you have to live to the march of your own drum. You invest, You save, emergency fund, savings account, investments, plan, spend, do it over and over and over, right? That's what it's all about. As a financial advisor, I kid you not, when I have a new client, we talk about what you have to do. But once you're set up, we talk more about what not to do. Kind of like golf. How do you minimize your golf score? By minimizing mistakes, not by going for the Sunday swing on every time you step up to the ball. 10-year yield down to 4.6. Weren't we all just talking about this hitting 5% any minute? Hit about 4.9%. Now it's 4.6, backed off. And as that backs off, it's starting to make stocks a little bit more attractive, starting to make investors feel a little more confident that maybe the Fed really is done. With everything going on in the world, it's really hard to imagine the Fed raising rates. VIX was down to 17. Not a bad thing. Okay. So I think investors just got overly negative, overly bearish. Too many investors sold out of stocks as an asset class, went into bonds. And now they're just paying the price of overreacting. And we don't want to pay the price of overreacting. We want to take advantage of somebody else's overreaction. That's for sure. But we don't want to pay the price for that. That's why we invest with a plan. We are on a mission, you and I, to maximize your dollars and to minimize your mistakes, potentially. And if you want to know more about this, you can reach out to me at clientfirststrategy.com, or you can call me at 631-920-6624, 631-920-6624. So let's take a look at a few other things. Let's take a look at defense stocks. And I want to compare two of them right now. Here we go. This is going to be good. We're comparing two aerospace and defense stock exchange traded funds. One is from Spiders. That stands for Standard & Poor's Depository Receipt S&P Aerospace and Defense ETF. The Spiders are sponsored by State Street. And the iShares U.S. Aerospace and Defense ETF. iShares is part of BlackRock. These are two exchange-traded funds that are designed to help you capitalize on the same trend in the same sector. Aerospace and defense is a subcategory of the industrial sector of the economy. They're both up a little bit today, but why is one up 1.3%? The other one's only up 0.5%. What makes these two different? Well, let's scroll down and let me just get down here. And let's keep comparing these two. Compare, and contrast. Okay, that's what we'll do. So the one from State Street, the Spiders. Just make sure I'm looking at the Spiders, right? Yeah, the Spiders one has an expense ratio of 0.35. All right. Where the other one, the iShares one, is 0.4. So pretty close, okay? One has a dividend yield of 0.49%, and one has a dividend yield of 0.9%. So the one with a slightly higher expense ratio has about double the dividend yield. Yet the one with the from Spiders is up 6% year to date, 21% in the last year, while the other one is down 2%. The one from iShares and only up only 15% in the last year. What's the difference? Well, let's see if we could gather. I have to kind of make these a little bit smaller because it's hard to fit everything in one screen. I hope you can see this. Okay, that's a little better. Just bear with me for a second. I'm trying to really, all right. Let's see if I can make this a little bigger without losing all the information. No, I can't. So I'm just going to make this a little smaller. And sorry you have to strain your eyes, but I'm going to talk while I do this. Okay. So let's see the difference. Why is the one on my right anyway, the one for my shares, not doing as well? For one thing, the biggest position in it now is Boeing, and Boeing, as of late, has been doing poorly. But it's 18%. Boeing, its biggest holding, is 18%. That's a lot for the biggest holding in a fund. Whereas the one from Spiders, the biggest holding is Curtis Wright, but nothing goes above 5%. Everything is like under 5% holdings, as opposed to the iShares. It's got large positions, it has large chunks of money concentrated in a few individual stocks. So the one on the right, I think, is taking more risk, more concentration risk in a smaller number of stocks, meaning less diversification, which means when its stocks do well, this fund should outperform easily. And when the stocks don't do as well, it'll underperform the other one easily. By the way, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. So you have two very popular exchange-traded funds, one from Spiders and one from iShares. They're doing very differently because even though they have the same name, Aerospace and Defense ETF, as you can tell, the makeup of these two portfolios are rather very different. So therefore, you get different results. So which one is for you? Do you want the one with more concentrated positions with bigger upside, bigger downside, more volatility? Or do you want the one that still has exposure to the industry, but in a way with fewer concentrated bets and therefore offering you a smoother up and down ride? Which one is for you? And these are the kinds of things that a financial advisor would help you decide. So that's the battle of the ETFs. And if you want to play the theme of political strife, geopolitical strife, I should say, if you want to play that theme of geopolitical strife, if you believe that defense contractors should be getting lots of money to produce lots of munitions and equipment and replacement parts and new weapon systems, then here's your way to do it. But you do have lots of ways, or you could just buy the individual stocks. For example, Lockheed Martin, Northrop Grumman, RTX Corp. RTX Corp used to be called Raytheon, by the way. So lots of ways to be in the sector. And depending on your personal finance is how we would pick the right one for you. All right, that's about it. I want to thank all of you for watching. We'll see what the next couple of days brings. So far, so good for the month of October. And again, markets like this, where the market's going up, when you think all the bad news is just piled on so much that the market has to go down a lot more, the market goes up. This is what makes short-term investing so hard. And it's why we focus on long-term investing and we focus on the things we could control, like your personal finance habits. Have a great night, and I'll be back tomorrow.